2012 marked a challenging year for the surplus lines insurance industry, but that's not the story for 2013, says Jeremy Johnson, president of Lexington Insurance Company. Whether or not 2013 is a good year for the E&S market depends on how the industry underwrites. Johnson says that so far underwriters have not priced foolishly, and an uptick in the U.S. economy, a positive property casualty rate environment, and strong industry surplus for U.S. insurers is leading to an improving bottom line.
Well, 2012 was a tough year. Superstorm Sandy had a really profound impact on the results, and that was particularly impactful on the E&S industry, which for the first time in 10 years underperformed the P&C composite. But when I look at 2013, look, so far it's been a relatively benign year from a cat perspective. So I think assuming that we don't have any events between now and the end of the year, it'll be a good year, and we'll see a return to that historic outperformance. But if you think about the volatility that we've experienced in the last decade, 2011 was the worst year in history for cats. We look at cats and don't think about cats in terms of a geographic or a seasonal limitation. I think when you're looking at cats, the lesson that we've had from the last decade is you really have to expect the unexpected. Sure. Now you think about the flooding that we've just had in Colorado, or the tragic tornadoes that we had in Oklahoma, the hailstorms in the Midwest, or the quake in Japan, the quakes in New Zealand. There's a lot of volatility. So whether or not 2013 is a good year, in the E&S business, we're underwriting to volatility. When you underwrite to volatility, you have to have a lot of capital. I would say that all market cycles are different, and in my career, every market cycle has been precipitated by a different cause. It's had a different duration and a different resolution, if you like. But this market cycle is certainly being driven by low interest rates. And when you have the low interest rate environment that we have today, you've really got to underwrite to a really aggressive loss ratio, and able to support the capital that you have in the business and to provide a return on that capital. Mm-hmm. It is interesting. The industry is very well capitalized. We're at record highs with over $600 billion of surplus, and to a certain extent, supply outweighs demand. The ratio of net written premium to surplus is at an historic low, about 0.77. So you might think that pricing will be going down with that supply outweighing demand, but it's not. We're not seeing foolish pricing. And then we're seeing a gradual uptick in the US economy, and especially in some of those bellwether industries that are good for E&S, construction, transportation, energy. And then the rate environment is still quite positive, mm-hmm. So that contributes to a top line growth. It also contributes to an improving bottom line.